What is SORR? Well, some might think, well, this sounds like something exotic. It has nothing to do with it. Well, 1 in 3 viewers of PGurus channel are on fixed income, meaning retirement or annuities, what have you. And using SORR by the banks in India with RBI adopting it is going to be good for you. And that's why you need to watch this thing, because unless you see what the RBI has done now, you will not understand how worse things could have been if it had continued the way it was, for example, using MIBOR. I'm going to talk to you about the big changes coming in finance. Please remember that Secured Overnight Financing Rate, SOFR of United States, and this is the most important thing. Secured. What is secured? Secured means that any loan that will be using this has to be secured, meaning it has to have a collateral, meaning it has to have girvi. Before, it used to be not the case. As a matter of fact, I'm going to give you some warning signs as we go through this slide deck. We go into it a little bit deep so that we understand why India is responding to the world changes so quickly. I'm glad they did it. SOFR came into being in the United States in 2019. SORR has just come into India 6 years later. Better late than never, but I'm glad that India has shed its older connects with British system, which was MIBOR, which was based on LIBOR, or it was, let's say, inspired from LIBOR, and going with SORR, that's a good thing. It also tells you that America is the one that is going to be driving the finance of the future, and India is aligning itself firmly along those lines and not the colonial line. That's a good thing. So let me just tell you what more you can expect from this, because a lot of things will start happening in the days, weeks, months, and years to come. This is a big change. What's the most important thing here is it gives you greater transparency into what you can expect in terms of yield, in terms of returns for your investments. Hopefully, this will also make it better for you on your return on investment. I have a small slide deck. I request all of you to please like this, even though it might look a little bit, exotic. Why am I worrying about finances? You are worrying about finances because every one of us eventually will have some fixed income once we are heading towards retirement. We want to make sure that income is maximized with least amount of cuts here and there and so on and so forth. Here we go. India's monetary makeover now involves SORR. It is actually a big deal that has changed in terms of what used to happen before. Before, we used to have the Mumbai Interbank Offered Rate, MIBOR, and this was essentially tied to LIBOR. LIBOR was caught with his hand in the cookie jar. I've said this thing many times. So it was important that LIBOR be anything to do with LIBOR, all the various mechanisms be shed aside and go in with a new scheme, which is the SORR, and this is modeled after the SOFR. And I'll tell you what that means. It's not that we are copying the American system, we are adapting the American system in India to try and make this thing more transparent, more powerful, and it is also going to give you a better return on fixed income investments if everything goes right. But I want you all to follow this thing till the very end, because maybe a little bit finance related, but it's important to understand why this plumbing has been changed. See, plumbing you don't change, right? It's underneath the house. If you change in the plumbing, a lot of things will break down in the house. So you don't change it, isn't it? So similarly, the financial plumbing of India has been changed, and how this affects you, it's very important to know the consequences. So this is why I want you to stay till the very end. Now, the SORR has captured almost 98% of the overnight money market activity, encompassing secured repossession and TREPS, while the MIBOR represents about 2%. Now, what happens is between banks, there's almost always some amount of lending and borrowing happening, because a particular bank, like for example, let's say there's an earthquake in some area, the banks around that will need a lot of money. So what do? They'll go and ask the other banks to say, okay, we need to fulfill some of our requirements in terms of payouts and things of that nature. So we want more money now. We'll give it to you later at a certain rate. So there is a rate that is agreed to. That is what is now going to be based on the SORR, and these rates, depending upon where it is happening and how it is happening, all these things are now beginning to fall or use SORR. And this thing is defined every 24 hours. That's how SOFR is. That's what I'm assuming that the SORR is also. So every 24 hours the rate changes. So today if you make a deal for rental agreement, you will have a particular rate. Tomorrow if you change it, if the agreement signs tomorrow, you will make sure that in the agreement contract you update it with the latest number. Make sure of this, viewers. Please make sure that if you are signing any contract, rental agreement, leasing agreement, EMI, a car loan, any other scooter loan, whatever term sheet that you'll be given to read, you have to look through that carefully and make sure that the rate at which you are being offered the loan, that changes almost every day. So make sure on the day of signing that you have the right rate. I'm just advising you. I'm not saying that this is right or wrong. I'm just trying to tell you that that is more accurate. It might change, it might not change. It might go up or it might go down. You have the small variations here and there, but do make sure that you understand what you are getting into and do read that fine print, 5-6 pages of data on when you sign a loan agreement. Why is this being done now? I told you LIBOR was found to be flawed. People were basically gaming the system. And what was it that they were gaming? I'll give you an example. I told you about collateral, right? Any loan you have to have a collateral. Turns out that in LIBOR, people were not using collateral for some of the loans. They used to come up with a term called rehypothecated. Hypothecated is essentially collateral. So you will see some stores having that hypothecated to Indian Overseas Bank. This used to be very common initially. I don't know if they are being required to do it now. If you have a new company, new premises coming up, new business, they'll usually say we are hypothecated to blah, blah, blah. Problem is that many loans were given wherein the asset is the same. The first loan is given correctly against the asset. Then the same asset is being used again and again and again and again, and that is called as rehypothecation. Guess what? That doesn't work in real life. That was one of the prime reasons why SOFR was introduced by United States. They said you need to have new money, new collateral to draw up a new loan. You can't use the same one. I'll give you an example. Many ETFs on gold. Today, if you ask them, well, you told us when we signed up that we can exchange the money that we have in your ETF for the gold, give us the gold. Just ask them that. Give us the gold. You are in for a surprise, because I'm hearing that many ETFs do not have the gold to give you back in lieu of your investment. This is happening mainly because of rehypothecation. I told you, I think I've done one session on gold, and that's just an example where this was what was found. So that's why the plumbing has changed. LIBOR is out. Even United Kingdom is going with a new one called SONIA, SONIA, Sterling Overnight Index Average. US is of course Secured Overnight Financing Rate. And what happens is this new scheme reduces manipulation risks that were associated with the LIBOR, London Interbank Offered Rate, and hence MIBOR. Short-term volatility is expected as a market participants adapt pricing and risk model. That's why I told you, right? On the day of signing your loan agreement, check with the person who's issuing the loan. What is it based on? Is it SORR? Google for what the latest SORR rate is. Make sure you don't get dinged. All I'm trying to tell you, viewers, is be watchful. Look at that. Also, if there is, let's say you're getting annuities, like so much money every month from a certain investment. Make sure you know what the rate at which it was computed is aligning to, and make sure that there is no skimming going on. I'm just saying these things happen. This is just like if the price of crude goes up today, the pump starts showing it immediately, whereas when the price of crude goes down, I haven't seen the thing go down, by the way. It does go down nominally, 5 rupees here and there, that too only during election time just to get votes. Otherwise, you don't see that happening. This is the unfortunate reality of the world. It is not just in India, it's in United States also. Many people have actually sued governments like state governments like California, saying that if you are raising rates at a certain rate, you need to lower the rates at the same rate so that you are fair. But it's easier said than done. It doesn't happen often, and that's where we are today. Anyway, So what happens because of SORR? A couple of benefits for banks. The banks that have access to high quality collateral. What is high quality collateral? High quality collateral is something where the person or the asset that you have is a guaranteed, sovereign guarantee. For example, if you have government securities, that the government stands behind it, you're good. Or if you have something else, like for example, gold collateral, those are all excellent collateral because the asset is very well recognized and it is secure. Even a house is good, but you can't use the same house to get 4 different loans. That's where the problem is. Okay, so what happens is many of the smaller banks tend to use unsecured call markets. They may find some funding pressures because of SORR. They'll have to fall in line. They'll have to find out how they can be part of the SORR stream so that they can also benefit from this increased transparency in the whole transactions. When you have this kind of a market reform, that actually reduces frictions in unsecured markets also, and it also incentivizes improving collateral management of these banks. You have a lot of cooperative banks. That's another mess on its own. I don't know when that is going to be fixed. Interestingly, do you know that Amit Shah manages a new ministry called cooperative banking or something like that? I think this was basically done to try and put a crimp on people like Sharad Pawar, who were the big staunch advocates of cooperative bank system, like sugar mills and things of that nature. And what happens there, no one wants to know. Anyway, that's why RBI doesn't even give cover to that. What are the new investment opportunities for investors? Treasury bills, commercial papers, and certificates of deposits linked to the SORR are likely to experience increased demand with greater transparency, attracting more institutional participation. The transparency is there every day. You can look up Google and you'll know what the SORR that day is. You can calculate what your yield is. Like for example, if you are trying to withdraw some money, you could withdraw it next week, but if you feel today's rate is better than what I might get next week, you can withdraw it today. I mean, these are people who understand finance. I'm just telling you an example. Any money market fund. What is a money market fund? Money market funds are those, at least that's how it is in the United States, where you have a certain security asset against which you have a money market account, and because of the interbank lending rate, the money market account more or less mirrors that, maybe a 0.2 or 0.15% less than that. For example, today the interbanking lending rate is 4.5% in the United States. So the money market secured account will give you probably like 4.25 or 4.3, something of that ballpark. The 0.25, 0.3 that is not given to you is their commission for running the whole thing. So let's say. So what happens is you have money market accounts which might be tracking SORR. Then you know instantly what your yield is on a particular day. This is useful for people who are moving a lot of cash. Like for example, if you are in jewelry business, you'll need bunch of cash to buy gold, and then afterward that money starts coming back to you during festival season when people start buying your products. See, you get the idea, right? In all these things, knowing beforehand how things are going to change in lending, that helps you plan your finances better. So whether it is fixed income assets or money market accounts, all these things are going to be better and smoother and more transparent. The growth of these swaps, futures, and forward rate agreements is expected with early stage volatility. There will be some volatility because there may be some ups and downs. You'll need to ride it out, and eventually it will settle down. I would say 3 months to a year. Now, the 98% SORR and 2% MIBOR coexistence might lead to some pricing inconsistencies, but that's only in the short term. The 2% will go away. That will also become SORR. India will be a completely SORR based financial system. And this is much needed. Like for example, United States has become 100% SOFR. The last contract that was signed on LIBOR that ended on March 31st, 2025. Now there are no more LIBOR contracts in the United States. I mean, these are things that are used even to do, like, if you're renting a commercial premises, you have to sign an agreement with your owner, and the agreement, the rate of increase every year those things are determined based on what the LIBOR rate used to be those days. Now it is either SOFR or some other number. Definitely LIBOR is completely out in the United States. Similarly, MIBOR will be out in India also shortly. So what happens to the derivatives that are based on SORR? Initially, there may be less trading volume as people get the grasp of it, but once that happens, you will expect that this will also start going up. Basically, the point here is SORR gives you better transparency and a smoother execution system, and in that way people who might be wanting to make a quick buck by being the middleman, they will be eliminated. That's my take on it. Now, sometimes macro events such as oil price shocks or capital flight, because somebody is giving a better yield than India, the capital will flee India and go somewhere else, could disrupt secured funding markets, necessitating close monitoring of overnight repo volatility. That's the thing. Every 24 hours this is going to be changing, and that's why you need to stay aware whenever you are signing agreements. Please let us know what you think about this. Many of you may be in the markets who might be doing signing deals here, there and everywhere. Tell us how things are with the new SORR in place. Do you draft agreements with that being the clause? Like for example, you could say the rent next year, I'm signing a multi-year rental agreement with somebody who has a huge complex. I'm using that for my office. Then you can say I'm going to sign the deal for 3 years, where after the first year, the rent increase will be SORR or 2.5%, whichever is less. I'm just giving you one condition. It could be other conditions also. So this SORR being in the mix of things is going to make things a little bit more interesting. By way of comments, you can tell us what your experience is as India transitions away from MIBOR and into SORR. So a lot of things are given here, words of caution, and also people are saying avoid exposure to MIBOR linked instruments, as the gradual phasing out will mean that the spreads will compress. Spreads will compress means yield is going to go down. That means your return is going to go down. That's the most important thing. So now I'm going to come specifically to retirees. Retirees who are dependent on your pension income, index based income, anything that is based on some market rate, all those things I'm going to come to now. I hope you have already liked this video, and if you have not subscribed to our channel, I hope you have subscribed to our channel. So it sounds a little abstract to retail investors. So what does this have to do with me? I am a pensioner in a certain place and I'm getting this pension. Well, there are some pensioners where the pension amount is linked to a certain number. That number used to be perhaps derived from MIBOR. Now that is going to be derived from SORR. Since SORR is something that is changing every 24 hours, you may have some variations in your payout. One month it might be 52,400. Next month it could be 53,400. The next month it will be 49,000 because of the changes in the SORR. So these things are something that, because if you know something is going to change, for example, if there is a war breaking out between two Middle Eastern countries, you know for sure oil price is going to shoot through the roof, and that means that there is going to be dislocation, prices will be higher, SORR could also go up because the price of money goes up. So these things will help you understand that, oh, there could be a problem here. Unfortunately, the increase in your return on your fixed income may or may not offset the increase in prices you are going to see on everyday goods because the crude price has gone up. Remember I told you that, right? Going up fast, going down slow or even never. Okay, let's say you have some SORR linked bonds. They could adjust faster and more accurately than what used to happen before. All these things used to be couched in, very few people knew about it. But now as the base of retirees is continuing to grow, you need to understand this. Also, if you are getting a fixed, pension, you may want to think about why not I take some of that money, invest it in a new SORR related bond, because I can track that thing better. Pension may not be able to adjust for inflation. Not all pensions are adjusted to inflation. Some central government organizations do have adjustments, but I'm not aware of all of them. I mean, even if one doesn't, I can't say that government pensions are inflation adjusted. So little things to remember by. Now there is Financial Benchmarks India Private Limited, FBIL. This is now starting to published the overnight benchmark rate. I told you SORR from July 7th. So you can go here and you can find out. What is the methodology used? All basket repo and tri-party repo TREPS trades executed on Clear Corp Repo Order Matching System CROMS and TREPS platform of Clearing Corporation of India Limited CCIL will be considered for computation of SORR. So you have to have a basis, right? I told you loosely that some banks in some areas may need more money in a particular day because there is some natural calamity and so on. So these things are the ones, basket repo, the TIPS as well as CROMS, these are all being done. And the benchmark rate is calculated based on the TREP trades executed on the CROMS platform and TREPS platform in the first 3 hours of trading, that is between 9 a.m. and 12 noon. The rate will be published by 12:45 p.m. every day except Saturdays, Sundays and local Mumbai holidays on FBIL's website fbil.org.in. So before you sign that important loan agreement, go to this website, find out what the rate for that day is. You may be in for a pleasant surprise. For example, if the rate is going down, you can insist that, okay, let's put the new rate in here so I can pay less by way of payments. Now, there are some things that could go different. For example, FBIL published the SORR at 5.29% for the one-day tenor as of 12:45 p.m. up from 5.32% on July 9th. So 9th to 10th, the number went from 5.32 to 5.29. This is a mistake. It's actually down at the same time. So these things vary. This is just an example of how this is going to operate. Important takeaway is this is a new way to also invest for people. SORR linked bonds that could give you a more transparent return on your investment, and you might be able to track it much more accurately than something else. These are all things that savvy investors will start jumping onto because the spread starts becoming huge after some time, and you need to be aware of that. So all I'm saying is this is something that is new. Please spend some time, especially on your fixed incomes or on your investments. Find out how many of them have transitioned to SORR. If they have not, call your banker, call your person who's managing your finances, ask them, why are we still with MIBOR? We should be with SORR because that's 98% of all the trades in India. This is the big takeaway, and SORR improves the stability and longevity of retirement income product. There you have it. So that is the big deal. Thanks for watching. Please like, share and subscribe to our channel. Don't forget to click on the bell button for notifications. Namaskar.